Okay, in this video, we're going to talk about the statement of cash flows. So, statement of cash flows is basically how the cash is going through the company. So, if you know what balance sheet is, here you go. I have random company. This is the balance sheet for 2020 and 2021. And then you have your cash. And then you have this is the balance for 2020 and 2021 for cash. The statement of cash flows explains what happens between these 2 points. So, how did it get from 24 to 43? So, and then also, if you're doing this for like homework or whatever, you have like additional information. And so, this is the additional information. This is going to be important because not everything can be gained from just what's inside the balance sheet. Boom. There you go. Assets, liabilities, equity. And we know this is correct because the total assets for 2020 and 2021 equal the same thing for this side. So total assets equals total liabilities and equity. Same number for their respective years. So this equals this, this equals this. Now, another form that we need in order to do the statement of cash flow, and this is the indirect method, we need the income statement. So we have BAM. And then we have BAM. So sales, 446, and then going through. This is a multi-step income statement. Now, when you're making a statement of cash flow, we don't really need this information yet because a lot of stuff that we're going to deal with is on here. Random company, statement of cash flow for year ended December 31st, 2021. Now, remember, you have 4 different financial statements. You have balance sheet, income statement, statement of equity, or statement of retained earnings, and statement of cash flow. The balance sheet is the only one that's instant. It's for that day, for the day of December 31st, 2020, and 2021. But income statement and statement of cash flow is a period. So from January 1st to December 31st, this is what happened. January 1st to December 31st, this is what happened. So we have 3 areas, 3 parts to the statement of cash flow. We have cash flows from operating activities, cash flow from investing activities, and cash flow from financing activities. And the first thing that we're going to start off with is net income, which is this one right here. So, boom. See? Same number, 60, 60. Okay, so we have net income, and then we have to figure out how to go from this number to the amount of money, amount of cash that came from operating activities. And so that's why it's adjustments to reconcile net income to net cash provided by operating activities. And the first step to that is income statement items not affecting cash. Example, depreciation expense. Depreciation expense is a non-cash activity. This, non-cash activity. This, non-cash activity. Okay? Cash actually didn't exchange hands. It just exists for accounting purposes. Boom. There you go. And boom. So you have 26, 3, and 1. Now, after you deal with that, you don't have to worry about the income statement for a while. Okay, after we deal with the stuff that's inside the income statement, now we're gonna move on to stuff that's inside the balance sheet. And what makes up the next part of the operational activity section is generally going to be the current stuff. So current assets and current liabilities. Now remember, this part we don't care about yet. Okay, so that's not operational. So that's why we don't care about that. Dividends isn't necessary for the operation of our business. And so, boom, there we go. So we look at whether it increases or decreases. And generally, it's a good way to remember how it goes. Like accounts receivable, if it decreases, it means that someone paid us money, and so that's why here it's a positive number. Increase in inventory, that means that we had to spend money to get inventory, so boom, negative number. Increase in prepaid expense, so if that went up, then that means that we had to pay money. Decrease in accounts payable, it went down because we paid off our obligations. Boom, negative number. Increase in income tax payable, that means that we still owe money, but it went up, so we owe money, so that means that we didn't spend money, and so that's why it's a positive. And then you get net cash provided by operational activities for this number. And we just went through, so you have cash, inventory, prepaid, accounts payable, income tax payable. And so, boom. See? So, accounts receivable went down, inventory went up, prepaid expenses went up, and then accounts payable went down, income taxes went up. And how I can quickly look at that from a glance is because normal balance for assets is debit, so anything on this side means that it would have decreased. So there's nothing here, that means it must have increased. There's nothing on this side, so it must have increased. There's something there, so it must have decreased. Nothing there, it must have increased. Normal balance is credit for liabilities. Boom, there you go. Now, here's some information that we need. All sales are made on credit. All inventory purchases are on credit. Accounts payable balance results from inventory purchases. Prepaid expenses relate to other operating expenses. That's stuff that we can use to try to figure stuff out. But most of it was pretty easy. You just go through, and then that didn't take actually that long. Net income, you do the income statement stuff, then you do the balance sheet stuff. Now, investing activities means purchasing of, we have something, big ticket item, equipment right here. So that's going to be cash flow from investing activities. And then if you remember inside of add information, equipment costing $21 with accumulated depreciation of $11 is sold for cash. And then equipment purchases are for cash. So that gives us information for how we're going to fill out this section. And the way you figure out is this doesn't give us some other information that we need. So to do that, so boom, account names, debits, and credits right there. Debits, credits. Remember, debits always comes first during journal entry. So accumulated depreciation is $11. We don't know how much it is sold with cash, and so we have to do the journal entry. We remove the 21 that's inside the information, and then accumulated depreciation 11 is also in the additional information. And then we also have the loss on sale of equipment, which comes from the income statement right there. And then we just plug this, the 7, to make the debits equal to credits. So if you add these three numbers, equals 21. And then in our ledgers, accumulated depreciation, boom. And the equipment, right there. So we have the 21 that we sold, that's right here. And then these are beginning balances for equipment. That's on the balance sheet. 147, 136. Now, okay, so you're going to have the 147, subtract out the equipment that you sold, but then that doesn't equal 136. In order to make that 136, you will have to have the purchase of equipment. Now that's going to be 11. Now, alright, so you'll do the math and you'll be like, wait a minute, that doesn't equal 136. It actually does. It's just rounding related. So now, if you did the math, it would all equal out, and it's all okay. So it just looks weird, but know that it's just rounding errors. That 11 goes into the statement of cash flow. Since you purchased it, it's going to be a negative number. So you have the sale of equipment for the 7, the purchase of equipment for 11. So net cash used by investing activity is a negative 4, because you can do the math. And then we have cash flow from financing activities. Now, cash flows from financing activities can be seen as when you're trying to raise money and activities related to that. So that's with dividends and bonds and then stocks if you give them out. So those are types of things that you'll see often. And if you want me to do a more complicated one, we could possibly do that, but that's in the future. So we have the balance sheet, the income statement. We have the loss on retirement bonds, right? So we answered this thing, right? Now we need to answer the loss on retirement of bond. So we need to do another journal entry. Bam, right there. Loss on retirement bond, 1. The bonds payable would start off with, inside the ledger, it was 38, but it's now 0 for the current year. The ending of the current year. And then it obviously decreased by 38. So in the journal entry, we do that debit 38. And then again, this is a rounding thing. So you'd say 38, 38, 1. That doesn't make sense mathematically. See, mathematically it makes sense, but it's a rounding thing. So then now we have the cash, and that's what we needed. So we're going to input that into the cash that we use to retire the bond, which is the 38. And then we have the next level, which is, remember the dividends payable? Now we're going to deal with that. So you have the dividends payable, what start off at 5, what ends at 0, and so that's going to be dealt with. But if you just take that number, that's wrong. The reason why is because you also have retained earnings is related to dividends. So the balance of retained earnings is affected by dividends declarations and net income. And so we have to do that part. Retained earnings. We start out at 62. We end at 108. And then we have the 60 from the income statement right here. But if you add those together, it doesn't equal 108. That must mean that we paid out dividends, which is the 14. So then you have the 14 plus the 5 equals 19. And that's how we get the 19. And these are negative numbers because we are paying it out. So cash is leaving our company. And then that then is net cash used by financing activities is 57. And so then we take these three numbers, we add them up to get net increase in cash of 19. The cash balance at prior year end, which is 24, to get balance at current year end, which is the 43. And that tracks with what's inside the balance sheet, 24 and 43. And these are all done as formulas. Boom. You see that? I didn't hard code anything. They're coming from hard type any numbers into the statement of cash flow. They're flowing from either the income statement or the ledger, or they're using some adding things up, or just the simple arithmetic. And then that's our statement of cash flow. And then you know that you did correctly because it should equal, the 43 should match with this. And add the 19, you get 43. And then you have the cumulative depreciation. This is what we sold. This is our depreciation expense. This is our net income. This is our dividends. And then these are all the different stuff that's happening that goes inside here. Increases and decreases. And now we've answered every part of the statement of cash flow. And then we answered, why is this different right here? See? And all of this stuff, see, they're all flowing from the ledger. So this stuff, I've made it so that each one, it goes to different parts of the balance sheet. So I'm not typing in anything. That way, if I mess up somewhere, I can just quickly fix it. And that's it. That's the video. If you have any more questions, leave it in the comment. If you have anything else that, any other problems that you want me to go over, leave it in the comment. Make sure to subscribe. And I also do daily videos of my web novel series, so check it out on my main channel. And there's easy playlists that makes it easy to navigate. It's a typical fantasy zombie type story, and so you can listen to that, and I think it's pretty cool. So make sure to like the video and then share the video to anyone else that's working on cash flow statements.